What's up, everybody? We're back with the Holy Macro Show. It is Saturday morning. Yes, usually we do this on. Let me get center here. Oh, my chair's moving around. Normal Saturday morning stuff. But instead of Saturday morning cartoons, will be Saturday morning macro. So a bunch of stuff to talk about today, and I think one of the greatest things we can highlight is what is going on with the Fed. What was that Fed meeting? What exactly are they doing, and where exactly are they going? Because man, that was the constant, hey, we're never going to waver on inflation, and inflation is what we're going to be fighting till the end of time. And then, like, you kind of think about it, you go back to the old Richard Russell saying, inflate or die. Like, that's the Fed's choice. It's always inflate or die as a central bank, and really they'll continue to inflate till the end of time. And I think that's something that we'll probably continue to see in our lifetime, more inflation, until they're pushed to actually fight inflation. So, Kashab, I know you watched the Fed meeting. What are you thinking about that Fed meeting? Because it was very interesting.
Yeah, so I mean, there was this one moment which just cracked me up, and that was Wash coming and saying that the Fed was in the performance business. I was like, yes, we can quite see the performance that you're putting up, like saying that you had a good old-fashioned family fight and that, the dissents are kind of not a big deal, and that, yes, you are going to act tough on inflation. At the same time, he comes and says, yeah, well, we did more than talk, even though we did not take any action. And you're like, wondering what exactly did they talk. So after a lot of back and forth on this, he comes and says we are in the performance business, and I'm like, oh man, this is just too hilarious, and it kind of gives this feel that this Fed has completely lost it. Like, just acknowledge already, like it's been almost 6 years that inflation is above your so-called 2% target, and that's not even like a soft goal. They say that's the target, right? And you have not hit your target for more than 5 6 years. What do you do? Well, either say that the target has changed and you're not going to be able to hit your old target, but you have a new target you're going to hit, or really do something about it. And all you get is talk, talk, and talk, and then a comment saying we are in the performance business, and it's just ridiculous. So I found the whole thing just complete nonsense, frankly. Like, whether they hike 50 basis points, 25 basis points makes no difference, because the very first line in the FOMC, the press release, what they say is that they want to have ample reserves in the banking system. Now, what does ample reserves mean? Well, it just means the Fed is going to print more money. So they called it QE, then they called it Operation Twist, then they started calling it Reserve Management Program, and now they're just saying we want ample reserves in the banking system. So it's just QE, money printing by another name, and that is all we are really getting. So all this talk about being tough on inflation is just pure nonsense. Come on, I mean, like, everybody knows this at this point, and it was, in fact, not even hinted at subtly in the conference room. So usually, when you see the press members asking questions, like especially the Powell conferences, like they do really ask tough questions. And this conference, you saw none of that. You just saw everyone kind of repeating the same line over and over, which is, what exactly are you doing at these meetings? And yeah, you say that you're going to do more than just talk, but what exactly have you done? Multiple versions of this question went around, and there was no answer. So it was performance data through and through, and the bond market saw it that way. And in fact, I would say the only illuminating thing that we got out of this meeting was when Wash said, we are not hiking, but the market is hiking, and we are aware of that, and we are happy about it, or something like that. And I don't know if he's really happy about it or he's just happy. He does not have to act because the bond market is acting, but that was, I think, the only kernel of information that I actually got out of that meeting. So yeah, like, I would say, if this is what we're going to get out of the Fed, they can pretty much be ignored. Just look at what their balance sheet is doing. Just look at what the deposits in the banking system are doing. Just look at the bank credit growth. Just look at the money market fund balances. And you don't really need to worry about the Fed, because the way they are acting, they're sort of becoming a non-entity in the markets now.
Yeah, I mean, if they're not worried, because they're already having. And it's funny because people like brought that up to me. Oh yeah, the 30 years moving higher, so it is like a rate hike, or this is happening like this, so it's like a rate hike, and all of that is complete bullshit. Like we're talking about the interbank lending rates, we're talking about LIBOR rates. Like this is a completely different thing than looking at the long end of the curve. However, that's what they're saying right now, which is complete bullshit, which is making your point, which is who really cares what they're doing anymore. They're just making up things about lower inflation and so on. But if they can keep doing different metrics and they keep doing it this way or that way, we're just going to continue to have higher and higher inflation. And this is really, and especially if they're just going to tell people, hey, the market's giving us rate hikes, so inflation will come down soon all on its own. That's complete bullshit. The short end of the curve is what they control. That 3-month rate, that 1-month rate, that overnight rate, those are very important to the market because banks continue to loan money. And as they're loaning money from that lower rate, they're loaning it to us at the higher rates. So they're going to continue to push those loans as they're able to make more and more money. I mean, it's simple. So, but once again, they think it reminds me of the Warren Commission report when JFK got shot, and Admiral House, they wrote up the Warren Commission report. Honestly, half of it, and this isn't really that much of a conspiracy, and if you guys really want to dig into it one day, we can. But basically, you're watching, everybody's reading it, and they're going, "Oh my God, what are the American people going to think? This is all bullshit." And Admiral House goes, "Well, the American people don't read, so it doesn't matter." I mean, that's kind of what we're looking at today with the Fed is like, well, they don't even know anything about interbank lending rates or any of these things, so it doesn't matter. So we'll just keep pretending everything's fine here. So it just makes me kind of it's just hilarious. But once again, this is the rate we're talking about. This is that spread. So this is where the Fed is. The Fed is holding rates low between 3.5 and 3.75 currently. And they've just been on hold for a long time. But as that's happened, basically as they started lowering rates, actually, the long-term rate went higher. And then as they're holding it lower, the long-term rate continues to rip higher. I mean, this is them completely ignoring what the bond market is doing, what it's saying, and saying, "Hey, we know better. This is all transitory. This is all gonna change soon." This arrow's bothering me. Sorry, guys. I didn't notice that change so much, probably just from the last couple of weeks with this big move up in yields. But yeah, so generally, we're just looking at this market, and the long-term rate continues to go higher as they hold down the short-term rate, creating more money for the banks to loan out to us. And as there's more money in the system, it's going towards inflationary assets. And as it's going toward inflationary assets, we're going to continue to make money being short the bond market. I mean, that's really what it is. So, glad everybody who's hung on to those bond shorts. It's been a tough trade. It's been a lot of volatility, but really it hasn't been that tough. It just hasn't printed a ton of money. Now it's kind of moving the right direction. We'll see where it ends up, but I like the breakdown in TLT right now. I like the breakdown in ZB. That's the 30-year bond. So you want to be in those long-term rates on the short side currently. And I think that's a very simple way of doing it. But Kashop, looking at the long-term rate, TLT, Ricardo ended up putting this chart up. I thought it was really good. Now TLT was launched in 2002, so it's not as old as obviously the bond market in the United States. But since its launch, this is its lowest monthly close possibly ever. Oh, wait, no, sorry, it is August 1st. It is ever. I was gonna say if the monthly close is down here. So Kashop, what are you thinking? How low can these things go? Do you think it's a situation where it's like, there's a bottom in the floor of like bonds, kind of similar to oil at times, like there's like a bunch of buyers at a certain level or something, or do you think this thing could just keep crashing into perpetuity at this moment?
So the Fed, what they're doing is they whenever they one of the bonds on their balance sheet matures, the agency securities, not the treasuries. So what they are doing is they are replacing it with T-bills. And earlier, at least before Wash, the policy was that they will try to match the duration of the portfolio to the duration of the treasury issuance. That was a stance that they took, and that was mainly so that they could control the long end of the bond market. In fact, the treasury has done quite a few buybacks, which sounds insane because they're just borrowing money and using that to replace their earlier borrowings. But they have done quite a bit of buybacks, and all of that was to make sure that the bond market doesn't blow up. And by bond market, I mean the 30-year, because let's face it, like even in inflationary times, you're probably still going to lend maybe 2 years out. If you're an institution, maybe you're comfortable lending 5 years out because it's a lot easier to forecast inflation 5 years from now than 30 years from now. 30 years from now, who knows what the purchasing power of a dollar is going to be like. We have all seen the Home Alone movies where, whatever you bought for $5 back then is probably $100 now. So obviously, people are not going to want to lend much longer on the longer duration treasuries when you have this kind of inflation going on. So what the Fed did was try to sort of smoothen that out. And now when you have Wash come in and say, the market is hiking, so we don't have to. Well, that just means that treasury yields are going to soar and soar and soar until at some point the Fed is going to step in and take over the rate hiking function. So I really don't see that happening. And I think, in fact, I think the only way that happens is if we get a 7-5 vote at the FOMC saying that they have to hike, and Wash may disagree, all the Trump appointees may disagree, but the action gets pushed through. And that's going to be unprecedented in Fed history. And if that happens, so if the rate hike comes through in that way, the bond market is going to see it as not just a family fight, as Wash is putting it, but as an existential crisis within and around the US government, which means the debt is going to be priced very, very differently. So either way, all I can say with certainty is that the era of low interest rates is definitely over. The Fed can take rates to zero, they can take it to 5%, they can have their family fights, whatever they do. I see 10-year yields going beyond 5%. I think that's a given. And I think 30 years, who really knows? Like, is 10% a good discount rate to get you to invest in 30-year treasuries and actually hold for the duration? I think not. And I would not make that bet. I don't think anyone who's retired would make that bet. The only reason these things trade at such a low yield is because everyone says, oh, if inflation picks up, I can always sell it to the next guy. But what happens when the next guy doesn't show up? It's the same problem that private equity is having. So, private equity, they said, I'm going to buy this real estate, but not to worry, you can get out whenever you can, even though you can't sell the building, which was crazy. But they are like, yeah, we can always borrow, we can always give the money, get the money from somewhere, and we'll pay you. And then everyone started asking for their money back, and they're like, hey, we can't pay you. And now there's a run on private credit. So can there be a run on 20-year, 30-year treasuries? Absolutely, there can be. Like, just to give a context, like, I mean, I'm not going to talk about crazy countries, like Venezuela, Brazil, all those Cuba kind of situations. Like, let's just pick Austria.
Mhm.
10 years back, Austria had these 100-year bonds. And
Yeah.
what, yeah. And now I think they are trading at 30, 40 cents on the dollar. That's it. Why? Because, well, there was a crazy yield. Who even knows if the Australian government is going to be around in 100 years? Who even knows you'll get your money back? So, the British, like, they have these things called the consols, where you would only get the annual interest payment and you will not receive your principal ever. And those bonds died. So, whatever you collected was all that you got. So, let's say you paid £100 to buy the bond and you got £4 in interest, then that's it. You lost the rest of it. So, we get these kind of crazy situations with bonds. It's just that in our living memory, we have not seen it happen, and we have not seen it happen to the US. We have seen it happen to Mexico, we have seen it happen to the Asian tigers, some of the Eastern European countries, we have seen Russian bond defaults, but we have really not seen it in the US, so no one's prepared for it. But I can absolutely see a scenario in the next decade where these 20, 30-year treasuries, they just go absolutely no bid, and whoever is just holding them, kind of either forced to hold on to them or literally sell it at pennies on the dollar. And I think that's coming. I don't know what that's going to do to the bond market, but That's exactly why you need to buy gold, because with gold you don't take these kind of risks.
No, agreed. I think it's a completely different system. And it's the reason why, we've talked a lot about this Kashop over the last couple of years, which is the idea that if you're in 60/40 portfolios and you have 40% in bonds, as much as everybody thinks that's so safe and, risk-free rates and all this bullshit, it's like we've been talking about it since 2020 pretty consistently. Even before that, we were talking about the fact that this could end, at some point. This whole bond dominance is going to come to an end. And then it came to an end in 2020 and nobody wanted to change anything. My buddy Stephen Weitzel had a really great paper he wrote called Pavlov's New Dog. And it's the fact of like people are trained, especially financial advisors, schools, universities, and so on, are trained to tell you that the 60/40 portfolio is the best thing in history, and it's the only way to always win in the market. And basically go back to 1982 all the way to 2020, it did really well. It was one of the best performing portfolios over time. However, you go before that period of time, it does very terribly. And currently, in our current state, since 2020, it's done terribly as well. So I just think that's a scenario that a lot of people just weren't ready for. And so in his paper, Pavlov's New Dog, he talks about the fact that people can't change their mind on this fact, that they think that we will just continue to be in bonds and they're going to do well forever. And as they're falling, hey, they've fallen before, but they always go back up. So let's just stay in bonds forever and ever and ever till the end of time. Sounds insane. And if you look at it, even from that TLT chart, you can see since inception, it chopped around in the 2000s when we had a lot of inflation. And then it just has been in an uptrend. It was in an uptrend in the 90s. There's an uptrend in the 80s. So huge uptrends over time. However, trends come to an end, and that end happened, and nobody wanted to change their mind. And still, I've been talking about the bonds going down since 2020 and being short, U.S. bonds since 2020, not to mention adding more and more to different countries over time. Now, currently, it's like I'm short damn near the entire global bond market. Anything I can kind of get my hands on easily that's liquid, I have been short, and that's been making a lot of money. And if you look at it, a lot of people are like, oh man, this is going to bounce. Oh man, you're crazy for being short TLT because of the short interest and all that. And people don't have any idea of what a bond spread trade is. The basis point trade that's been happening since basically 2020 has kind of skewed all the data. So a lot of people are short. And the reason to be short is to be long something else and make the middle. So once again, you'll even see sometimes like the 10-year, you look at the COT reports, the 10-year will have people massively, wildly bullish. And the 30-year will have people wildly bearish. Now, why does that make sense? They're highly correlated. It doesn't make any sense. The reason is that basis points trade. So overall, it's like this thing's ready to go. I agree with you, Kashop, that we have no idea how low this can go. And so the next chart is showing energy. So energy broke out, earlier this year in January, I think it was January or February. And so we started to get above those highs. Those highs go all the way back to 2008. We kind of were in a big range since 2008, and XLE finally broke out of that. But TLT, I've been waiting for that confirmation. It's just been chopping around, chopping lower, lower, lower. And now we finally have that confirmation of that breakdown. And so I don't know where this thing ends up. I've been talking about TLT going down for a while. I don't know how low it goes. Everybody, people love targets on prices. It's like what our industry as analysts is made out of. The analysts raise their expectation. The analysts lowered their expectations, whatever this bullshit is. For me, it's like this thing is moving one direction. I can hypothetically come up with numbers. I can do it fundamentally. I can do it technically. I can come up with numbers where I think this thing could go. I could use fib targets. I could look at the actual fundamentals of the underlying asset and see where I think it's going to end up. All of these things. At the end of the day, you have no idea where these things end up. You don't. Like nobody in the world would have said, hey, cocoa is going to go up 500% right now. There's nobody who knew that. There's nobody who knew gold was going to, Kashop and I, started, gold around thousands at certain points, under 1,000 at certain points. Nobody would have told us that gold could, nothing that we could have done could have ever said that gold will hit, $5,000 and it'll be at this time in this year. Last year, the gold miners moving the way they did, like nobody can tell you the percentage of the move, but what we can tell you is that, hey, the probabilities are lined up on our side currently. This trade should work out this way. This is what we're looking for. And then manage risk properly and let the chips fall where they may. That's the best thing you can do as a trader. So for me, it's TLT just breaking down. And as this breakdown's happening, I just want to be short. I don't want to overthink it. I don't want to do anything crazy. I just want to be short these bonds globally and see where they end up and keep running either a trailing stop or an exit signal, however you do it. If you even use targets, whatever, to each their own. But at the end of the day, I do think that this thing's heading lower. And I think that XLE is really saying it. Also, DBA is saying it. DBA broke out, came back last week a little bit. So we're looking at that. But to me, it's like if you look at everything inside of it, you look at wheat, you look at corn, even starting to make a nice move. You look at soybean oil, cocoa, coffee, all these things look really good. Like they're all set up to make big runs right here, right now. So I think this is an area you're going to want to really pay attention to as a trader. Now, most people go, oh my God, I can't trade grains. I don't know anything about wheat. Like, here's the thing that I wanted to say this the other day, and I was kind of laughing about it. I was like, you don't know shit about that company you've been studying for like 6 years. Like, I'll be honest, like, I don't like if you could sit there and dig through every single piece of information that you know about Tesla, let's say, and you really don't know shit about Tesla. Wheat is a very simple market. And however you trade, like that's the important thing is like if you trade on supply and demand dynamics, trade on that. You trade on technicals, trade on that, but don't jump around and be like, today I am a fundamental trader, today I am this trader, today I am that trader. Make your methodology. There's nothing wrong with mixing the two, but have your methodology of how you look at trades. And then you could do that across every single asset class, whether it's bonds, stocks, wheat, corn, it doesn't really matter. But a good way of taking advantage of it. I was thinking, Kashop, we should be sponsored by DBA at this point. I pump this ETF all the time because I'm like, it is actually traded very well. I like the way they do it. They seem to, have a certain amount of money in cash that makes a nice yield. And then they go around and put on the positions that they want to. And then they also add to the positions. They get rid of positions. I see the way they manage it, and I really like the way they manage it. So I like DBA. I think it's a good way of taking advantage of it, especially for people like if you don't have access to futures, you can't trade coffee or cocoa, or really, most of the softs, orange juice, lumber. You can't trade any of these things with an ETF. So you have to use the futures market. But if you don't have access to the futures market, you can get access to it through DBA, where it has a lot of exposure to these things. So Kashop, looking at the asset class rotation, and gold has even come down a lot towards commodities, and we're mainly talking about energy-based commodities, which are very correlated to wheat and so on. Wheat, corn, soybeans, agriculture, some softs. So gold has come down quite a bit compared to commodities. Stocks have come down quite a bit compared to commodities. And bonds have come down a ton relative to commodities. So what are you thinking about these markets? Where do you think money is rotating? Money is coming out of bonds, obviously. Money is coming out of all these things, going towards commodities. But what I want to ask you is what sector are you currently looking at in the stock market? Like, this is big picture macro, but in the stock market, what are you thinking of that's like a sector that people are not paying enough attention to currently right now?
So if you had asked me this, and I mean, we did have this conversation, I think it was in April, uh, 1 month into the war, and I told you that yes, the war is, kind of bullish for inflation. I know it's a wrong way to use that word, but the war was bullish for inflation, which means it's bullish for everything commodities. But in the market, the opportunity at that point was in buying software stocks. Now that goes against the macro the same way buying semiconductors did in early 2023. But that was the trade and it worked. And Yesterday, there was this news about this 25-year-old kid blowing up a $45 billion fund, and his trade was long semiconductors, short software stocks, and that blew up spectacularly in July. So uh, there is a macro angle which says that in the long run you really need to be in commodities, you need to be in gold. At the same time, sometimes you get these mini cycles that you can ride, and right now what we have seen is, so gold from 1800 to 3600, if you look at the price action, it if you look for a technical entry point, let's say you're a technician and you have the benefit of hindsight, and you go back and look at the chart 1800 to 3600, there was no real great entry point, no big correction, nothing. It was a straight linear move, and after that you started to see a little bit of a parabolic move and then a reversal, and then we had the huge parabolic move up to 5400, and then the retreat to the $4000 range. So uh, the thing with looking at just the macro and not looking at these cycles within the macro is that you really need to have a long term horizon to say, I don't really care about gold underperforming for 6 months. I'm going to stay invested. Now, there are people who have that kind of mental state where they take that view, and you and I, we take that view, especially when it comes to gold, because we have been in this trade for more than 10 years, and let's face it, we have a soft spot for it because we understand Austrian economics, we understand debt cycles, we understand what's happening to the money, the bond market, and all that. But if you're looking at gold as a layman, as a person who does not have that level of specialization, then the last 6 months you're just going to be like, there was a parabolic move, now it's done, I'm going to rotate out. Whereas for me right now, the obvious trade during the start of the war would have been buy gold, not software stocks, but I did the reverse. I bought software stocks and not gold. And now I'm doing the reverse. So I'm buying gold now, even though it's a dead market. And now suddenly everyone cares about software because, Michael Burry is in software stocks, and then this fund which is short software stocks is blowing up, but then this is the time to buy gold and not whatever is the obvious trade from the market perspective. So I would say it's probably the best time or the best entry that you can get, and especially if you add seasonality on top, this is probably the worst month for gold. And after this, from September onwards until March of the next year, it's going to pick up seasonality wise. So you look at valuations, you look at where the trend is, you look at where the price action has been, you look at the sentiment, and you look at the macro, and this chart that you overlaid, that's like the perfect tell that this is the time to get back into gold and the gold mining stock. So I absolutely am looking to add to my positions. And keep in mind, I haven't bought a single gold stock all year. I'm a guy who has been, since the start of my newsletter, I think I would have recommended maybe 30 gold stocks. And so that's 2024 to 2025. And I recommended 30. And this year, zero. And I think that's going to change. And I think this is the time to really get aggressively into gold.
That's interesting. That's a big take, because I'm in the camp where it's like I'm very 50-50 on it, but at the same time, I do think long term we're still looking at a huge move coming in gold. Like long term, I can't see any way that this kind of ends. Like, I think when you look at it and you look at the 2000s and you're like, okay, well, here's the pullbacks that happened back then. Nothing goes straight up, and I think that's the biggest thing nobody can think of. No trends go straight up all the time. I would wait myself specifically, especially trading like gold itself mainly, and some miners. I would wait specifically for this thing to show some form of strength. Now, once again, Kashop's a different guy than me. He's going to buy more on weakness. I'm going to buy on a little bit of strength. I'm going to wait for that momentum to get in. Kind of helps me to risk manage more properly, more comfortable for my style of trading. This is more comfortable for Kashop's style of trading. And that's also important to understand, is like nobody trades exactly the same. Nobody should trade exactly the same, because I am not you and you are not me. And you have to figure out how your personality fits into your trading, what fits into your time frames as well. It's like I don't really trust buying and holding things for the next 50 years. That's not really my style. And then also like day trading, that would drive me nuts. And not to mention, I've never really figured out a way to make that profitable. And I haven't seen many others figure out ways to make that profitable. So it's not something that I've figured out. Not to mention time frame, it would have never made sense for me. And then, trying to figure out that in between, which is trend following, more long term like me, that's how I trade. That fits my lifestyle, fits what I do. Waiting for signals helps me. I'm not much like Kashop's more of a fundamental guy. I'm more of a price action guy. So we both are macro people, but Kashop has more of a background in fundamentals. He can also do technicals too. And I have more of a background in macro and technicals, but I can also do some fundamentals too. But it's mainly the idea that like whatever fits into your straight trading strategy has to fit your lifestyle and who you are as a person, and then you'll trade better than the people who are just trying to force it because hey, I found this guy George Soros, he trades like this. And honestly, here's the other thing: you do not know how George Soros trades from reading a book about George Soros. Like he probably trades completely different than what you're thinking. You're thinking, oh, Great British Pound, I'll take out as much leverage as possible and I'll short this thing right now. And that's not exactly what happened. It makes a great story though, that people can try to emulate about going all in and being a pig and all these things that people think are really great trading axioms. And in reality, you look at any of these guys in any of their biggest positions, we're talking about 5-10% of their account would be their biggest positions ever. Retail traders, their biggest positions ever are 200% of their account or 1,000% of their account with options or something crazy. So it is a very different world out there. So any other areas, some people have some questions for you, Kashop. What do you think about Palladium? Um, you know, I don't know what if you have many thoughts on Palladium. I don't think I've asked you that ever. So what do you think about Palladium? Palladium stocks? Only thing I really know is SBSW.
So I don't have a positive view on palladium right now. So I do have a positive view on platinum, and I do own some platinum through PPLT. Palladium, I really wouldn't touch it because if you're really looking at, say, going into palladium, so why would you stop there? Why would you not go into aluminum? Why would you not go into nickel? And if you look at, the more niche the metal, if you look at what the risk reward is, you'll actually find more opportunities to invest in, say, a nickel miner or an aluminum stock rather than a palladium miner. So, or palladium, the metal itself. And if you look at platinum and palladium, it's so easy to make the case for platinum that my question is always, why bother? And it's the same response whenever people talk about scandium. Yes, that's been around forever and it's always like the next big thing and all that. But then the problem is the trade has never made money. And it's the same with these hydrogen fuel cells or anything niche that you look at. Like you are really not at the point in the commodity cycle where you need to focus on these niche metals because there is so much opportunity in the other stuff that it's just a why bother thing. Now, 2 years from now, let's say when gold is at $10,000 and silver is at 200 and all these mining stocks are fairly valued, and then you're like, where is the alpha? Then my answer might change. But right now, my answer is just don't bother with it.
Yeah, no, I agree. I think it's there's no real point in getting too crazy about it. So I thought this was an interesting question. Shop, do you value miners at $4,000 gold or a future price like 5,500?
So this only applies if you're buying something, which is, let's say you're buying something like a DRD Gold or a Dynacor or companies like that, where the business is fixed and all you're really making is the margin and you're valuing it based on that. Or, even you're buying a mature miner like Agnico Eagle, not much growth left. So you're just valuing it based on the sensitivity to the gold price. So I don't buy those stocks. So I bought those stocks in 2024, and since then I've just been going deeper and deeper into the growth stocks, which is your mid-tier producers, and then the exploration stocks, the stocks that are now on the ramp up to production, the ones which are in the construction decision stage or in the actual construction stage. So For those stocks, it doesn't really, the gold price doesn't really make a difference. What matters is the nature of the deposit, what the economics are per the PEA, PFS, whatever the studies are. And if you are looking at a drill story, then you know what the drill results look like and what the funding environment is for a stock of that sort. So those are the factors that I look at, not the gold price. And I think in general, you should not be valuing a miner as a call option at, okay, so they produced, let's say, $1 billion in net income at $4,000 gold, and the market cap is say 20 billion, and you're like, at 5,500 gold, they're going to be producing 3 billion in net income. I'm going to apply the same 20x earnings multiple. I'm saying the market cap is worth 60 billion. I would say you should not do that, because there's a lot of things that can happen in getting from here to there, and you can easily get disappointed if you apply that kind of math. So just use the current spot gold price. And more importantly, if you are looking at miners and valuing them on a PE basis, do a relative valuation. I'm not much of a fan of relative valuation, but if you want to really understand, is this stock cheap compared to that, and then understand why. For instance, Fortuna has a higher risk profile than say Westdome. So if you are comparing the two, then understanding the earnings, understanding the relative earnings, and looking at what the market is saying about that, that gives you a better perspective than using a 5,000 gold price or a 6,000 gold price or some crazy number like that. And if you see companies using these kind of prices to justify their investment in the project, run away, because the price is high enough right now. You do not need to actually do it at a higher price. Now, the uranium miners, we remember this era, Jason, right? Like uranium was $20, $25 a pound, and all the studies were done at 60. And their reasoning was, well, it's going to get to 60 soon, and at 20, we don't have a mine. So what do we do? Well, we value it at 60. And that made sense because uranium was historically cheap. And if you had asked this question when gold was at 1,200, 1,300, and said, this mine makes sense only at $2,000, and should I buy it? The answer would have been, yes, sure, there's optionality value. But with gold at 4,000, if you're saying this mine only makes sense at 5,500, then it's probably not a good mine.
No, I agree. I think it's an interesting subject because it's so nuanced, and I think so many people just kind of want to put it in a box and it's going to be this or that. And honestly, like, you'd never know where any asset's going to go. So like valuing things based on where you think it could be in the future, like it's like saying like, hey, I have this gold miner because I think gold's going to go to $10,000. Well, that's great, but why would you want to own something that only is tied to the price of gold? You want it to, if you wanted to outperform gold, like that's the whole point of owning miners in the first place. Gold is always going to be the safer trade. The miners are always going to be your alpha in that trade. So you have to get an understanding of where you want to be, how you want to value it for yourself, and then make your own models that make sense. And I think what Kashop's saying is like a great way to do that. That makes a lot more sense than just about everything other people do for the most part, because I hear that constantly. That's a constant thing in the fundamental community about miners is, where's the gold price? You'll see, like, that's what you see, the analysts do that all the time. They're like, you'll see when gold's at $10,000, this will be the best company in the world. And it's like, okay, dude, that's great. But that, think about like, I remember Kimberlake Gold back in, what was that, 2018. Gold just kept falling off of a cliff, and somehow Kimberlake Gold just kept holding up. And it was basically holding up really well for millions of reasons. One, it was the only producer. They had something with their mines. I can't remember. You might be able to remember better than me. But that gold produced from their mines basically was a lot cheaper to produce than just about everywhere else. So their stock continued to go up in a time where gold was just taking a hit all year long. Like, gold did not do good at the beginning of 2018 through the Q2 2018 and into Q3 2018. Kind of bottomed out at the end of 2018, but that was about it. So that's a good way to look at it. So Kashop, where do you see money flowing globally? And this is why I brought this one today, just kind of thinking about like something that I've been seeing. I got very excited about because it's been a while since I've seen anything from it. China started to make a move, up 14% in the last month against the S&P 500. KWeb, that's a Chinese internet ETF is up 13%. In the last month against the S&P 500. Norway's up 11% against the S&P 500. That was doing really good all year. That's very tied to oil with Equinor. So once again, where do you think money is flowing? I think this is interesting with China. I know you always have really good opinions on China. So jump through China or any other places you're thinking that it's making a lot of sense right now for people to be looking at.
So China, what's been happening is in the last couple of weeks, especially with this new open source AI called Kimi K3. So once that came out, there was a lot of interest in Chinese stocks, and in fact, one of the hottest IPOs. So you remember earlier, this, I think it was earlier this year or maybe late last year, where Zijin Gold had its big IPO, and it was way oversubscribed. And now the same thing is happening with the Chinese AI stocks. Now for a long time, the consensus opinion was all these Anthropic, Gemini, all these big American players that they were the leaders in the AI technology. And now with DeepSeek, with Kimi K3, and with Quen, and in fact all the other models that have come out, those notions have been shattered. In fact, the US companies are really scrambling. On the one hand, they like having cheaper AI to improve their own productivity within their company. And on the other hand, it's like the American technology dominance that's getting eroded. And what China has now done is they have introduced a new lithography machine, which basically replaces ASML. Now, ASML is technically a Dutch company, but everything that they give to China kind of needs the US stamp of approval. So they were kind of holding it over China's head for I think it has been more than almost a decade. So now China's come up with its own lithography machine, and they are like, they are going to break this dominance. So all of a sudden, investors have realized that the AI trade has bifurcated, and it's not just US centric. I mean, by US, it's Taiwan, South Korea. It's not centered on these countries anymore. There is actually a growing Chinese market, and investors want to tap into it now. So what we are seeing is capital flowing into China. Sure, that's one part of it. Driven by AI. Sure, that's also part of it. But interestingly enough, and I don't have the chart with me right now, but if you look at so US has the three big indices, and then so Dow, S&P, Nasdaq, and then the Russell, and then you have a few of these smaller indices. So China has quite a few of these indices, and if you look at what they have done year to date, there is a huge divergence. So the Hong Kong indices haven't done as well as the mainland Chinese indices. So there's a huge, like 50, 60 percentage points of performance difference between the leader and the laggard, which is crazy. Like it's one China, but two completely separate stock market performances. So what we are seeing is the flows are getting organized around closing these gaps, and also it's flowing back into China because they have proved their AI competence or the return of Chinese AI dominance. So those are the two factors. And other than China, what am I looking at? Well, Nigeria is the best performing emerging market. It's beaten South Korea before this big dip. So when South Korea was running high, Nigeria was running even higher, which makes sense because they have the oil, they have the refinery, they have the port, and their currency was strengthening. So it was like everything converging. Unfortunately, you cannot buy Nigerian stocks with your Interactive Brokers account, so couldn't participate in that trade. Uh, Other countries that I'm looking at, I think I like a list, but I'm not really looking at anything in these countries right now. So I think Malaysia is going to get very interesting if we get recovery in the softs because they have the oil and they have palm oil as well. So I think
I thought
Malaysia is
Malaysia is
definitely.
one of the more interesting ones. I mean, these are this is the 1 month through the S&P list, so these are the new ones that are kind of showing up on the list. But I think Malaysia is probably a very interesting one, even though it's the bottom of the list. That's one I've been kind of stalking for years as like a big emerging trade, but just haven't seen much from it yet. But I think at some point we will.
And Thailand is not in your list, but I think that's one of the better performing markets this year, something like 30% year to date.
Year to date, I think it's 30. Yeah, we're long. We're long Thailand. We're long a lot of international currently. I realized the other day, I was like, it's over 40% of the portfolio, which is a little bit larger than I usually go with any type of asset allocation. But at the same time, it's like these trends are working. There's nothing really to do besides that, and so looking at like Latin America too, Latin America is starting to show some strength again. Brazil had a nice run and then it pulled back quite a bit. Now it's back up again, 7% versus the S&P 500. What do you think about Latin America? Colombia's up near the top of the list, up 10% versus the S&P 500. Then Brazil 7. Anything else on there? Latin America 40 is up 5%. So what are you thinking about Latin America currently?
So I think Argentina's played out. It's already had a huge run up. There's no point in chasing it. Other countries, I think they are still fine, sort of middle innings, not early, not late. But I don't really have investments in Latin America other than the mining stocks. I don't have much exposure. But if you ask me whether I liked it or dislike it, I would say I like it.
Nice. Yeah, no, it's the same thing. It's I really do think there's a lot of value there. I think also looking at EWW Mexico, like that looks great. I think there's a lot of stocks in there. I think the, CX, the cement stock is also a very interesting one that could be a big mover going forward. And so I wanted to end here, Kashop, because I wanted to talk about something that I think is really important. And Wavy on time to trim oil refiners and integrate into midstreamers. I think it's time that oil refiners can be trimmed for sure if you want to. I'll ride the trends till the end, but I think, you're going to see more of the exploration side. So XOP and the stocks inside of that, I think you're going to start to see those start to make a big move. Kashop, do you have anything to add on that question?
Not really. I think, but with refiners, you have to be careful about their hedging program. So that's the only thing. And if you're owning something like HF Sinclair, really watch out for what they're doing on the corporate side. So they have proposed splitting the company, but it depends on a letter from the IRS okaying that structure. So if you are in that stock, you really have to watch how the corporate events move. If you are in an index, I mean, if you are in crack or something like that, then sure, that's a different story. But if you are in the individual stocks, just pay attention to what's happening there. And other than that, so Freely had this question about flows. Like I put up a chart of the Nasdaq 1 day move on Thursday, and he had a comment saying, "Can you talk more about flow?" So I think that's a question that we can end on because you kind of are the expert on flows. So why don't you talk about it?
I'm looking for the question. I don't see it.
No, it was on Twitter. So
Oh,
he
so
asked me, yeah.
what was the
Uh,
question?
so the question was, I put up a chart of the Nasdaq with the 1 day rate of change, and it was the highest 1 day rate of change in the last 1 year.
Mhm.
So his question was like, my inference with that was this is just flows, which means that flows mean revert, trends don't. So my what do you call it? My takeaway there was that we should expect to see a mean reversion. So that was what I posted with the chart. But maybe
And
just
so
talk a little.
was the rate of
Yeah,
change for an up day or down day?
for an update, it
Up.
was like more than 4%. Yeah.
So most of the time, this is the thing that's very hard about those rate of change moves like that, which is if you're looking for a trend reversal, they're very helpful. So, for example, you see gold is in this nasty downtrend it's been for a while. You see a huge rate of change spike to the upside. It might tell you something. You're looking at, let's say cocoa's been in a bear market for, God knows, 10 years, not doing anything. And then you see a huge rate of change move, might tell you something. Energy gets killed from basically 2016 all the way to 2020. And, after I think it was after the election in November of 2020, you saw a massive gap up. I think it was up, XLE was up 13 or 14% in 1 day. One of the biggest rate of changes ever in XLE at that time. That tells you something. Most of the time, when you see something in very large uptrends and then you have a big rate of change move to the upside, it's not really telling you a ton. Most of the time, that's just telling you, hey, this trend could still work, but also it might just be a bunch of people flying into something because it's been working for so long and they think it will continue to work. That's more what my takeaway is most of the time when I see a big rate of change move on something that's been in an uptrend for so long, because that means that everybody is still interested in that uptrend. Like, people love uptrends. People, that's how people get stuck in things. You have big parabolic moves. You got silver, for example, is an easy one that's recent. You get it going from 20 to 50. Nobody cares about it. It's going to stop at 50. It's going to crash right there. Gets above 50. People are like, yeah, this is going to end. Gets to 70, 80, 90. Now people are interested all of a sudden. They want to buy it. Hey, how high I'm getting questions every day. How high do you think silver can go? And I'm like, I don't know. I've been in it since 20. If it crashes today, I'm out at, I think it was, we got our stop out at 90, 91. Like, that's great. I'm happy with that. And they'd be like, well, do you think it can go to 200, 300? Because they're buying at these points of 100. I mean, that's insane. So once again, it's like the NASDAQ, I wouldn't be that excited about any type of rate of change move or how quickly it's moving or breadth or any of these things, because currently it's like, of course, everybody's in these stocks. Of course, everybody loves it. It's been moving for basically since 2008 or 2009. So basically March 2009, they bottomed out and they've never looked back, and they've been the best performing sector ever since. But at some point, bond yields really start to put pressure on a lot of these tech stocks. As yields continue higher, valuations also change as well. And the valuations for these companies continue to get worse. So there's a million things that you could look at here and go, hey, technology doesn't really look that great. Currently, there are some positions that I still have in technology, but they're getting closer and closer to the stops every day. And the other things are taking over. And that's why we talk so much about the idea of diversification, because the S&P 500 is technology. Without technology, there is no S&P 500 currently. Or the S&P, you take the returns from technology out, the S&P 500 looks like Europe, went nowhere for so long. And it would probably still look like Europe today. Like, Europe has changed as the dollar's changed, and they still have a lot of industrials and different things out there. We just have technology. Technology wasn't doing anything, we'd be in a nasty downtrend for many, many years. But now we're kind of getting to the point where these other sectors are picking up. But here's the other important thing to think. Technology is over 50% of the S&P 500. If energy, materials, industrials even, if all three of these sectors take over and look great and are ripping to the upside, they will not change the S&P 500. S&P 500, like, think about 2022. I think it was XLE was up 50% in 2022, and the S&P 500 was down 20. Like, these sectors are so small, it doesn't matter, which is part of the reason why we talk about them so much and why it's important. And so that brings me to the kind of the end of the conversation, which I just want to say, like, our job here isn't to, we do kind of a different thing here, Kashab. We're kind of teaching people how to think about thinking. Like how to think about markets instead of constantly telling them, like, this is what you need to do with markets. Like, so I think that's what we do here really well. So I think I just challenge everybody to go out there this weekend and kind of think about how you think about markets, because that's the thing you learn from other traders. Like, some people will be like, just follow me, you'll be great. Big newsletter services, they pump that all the time. Follow the guru. I fucking hate that word. Follow guru, follow this person, follow that person. They'll tell you exactly what to do, and you just follow them and you'll be a great trader. I've never met anybody who's a great trader who just follows anybody with their eyes closed. I don't know one of them. Anybody, and I have lots of traders that I've met that have subscribed to me, or traders that are friends of mine or people I've traded with that have become really good traders, but they always take what they learn and they put it into their own strategies and models and build it for themselves. And that's what I think, we do well, is like showing people like, hey, and that doesn't mean like there's not something that you can get suggested and buy and have a good time with. It just has to fit into your parameters as a trader. So, go out there and try to figure out what makes you buy and sell things, and that's going to make you a better trader. Great book that I'll end on as a good recommendation is Justin Mamis, When to Sell. This is a hell of a book. Nobody ever cares about it because guess what? Nobody cares. Even though, like, you get back test and you find out exits are greater than entries every day. Everybody worries about entries. For example, we're talking about gold, and it's like everybody's worried if Kashop's going to buy it at 4,000 and Jason's going to buy it at 4,300. And really, at the end of the day, the only thing that really matters is the exit. You can learn that from back testing. But When to Sell is really the only book that I found in markets that just talks about when to get out of positions. So definitely check out that book. Definitely think about when you buy, when you sell things, and be very adamant about the selling part, because I think so many people miss that point, because it's like everybody's looking for new ideas. Why do you want to subscribe to 10 services? Why do you want to read all these different people? Why are you on Twitter? You want more ideas, more things to buy. Really, at the end of the day, it's mainly when do you sell this shit? That's going to help you out more than anything else. But all right, guys, Shop, you got anything to add?
No, I think we covered quite a bit today. It's been great, in fact. So thanks, Jason. Thanks for doing this on a Saturday, and thanks everyone for tuning in. It's really what keeps us going.
Yes, absolutely. And thank you, guys. And please, definitely follow Kashop, Kashop286 on Twitter. And definitely, if you guys can share this, to anybody who needs it, anybody who wants it, we appreciate that. That really helps the channel grow. We're just here every week and we just enjoy doing this. And we've been doing this for a long time. So we'll continue to do it. And we will see you guys next week on Friday this time. Apologies, I had a family thing. So Friday this time. I will see you guys on Friday at 10 a.m. Eastern time. See you guys then.
Bye, everyone. Have a good weekend.